Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode. Hey guys, Charlie Jewett here on New Year's Eve. Nice. 2018 is coming to an end. It's been a great year. Thank you for all the support, all the reviews, all the people that got in touch, and all the people that we've helped. It's been a blessing. I appreciate you guys. I think you people are the best, but we're not going to end the show there. I usually say that at the end. I just felt inspired. Today I'm going to do an episode I've done this I think one other time, where I'm going to videotape it or kind of have a screen share and create a video right along with the audio, because there's going to be a lot of visual things that you may want to go watch on my YouTube channel at watchcharlie.com. So there'll be a video for episode 124. This episode's going to be the start of a 3-part series. Okay, we're going to do 3 calculations you must do, and I'm going to do 3 parts of this. The first is the 3 calculations you must know. You remember I did the 4 Google searches you must do, and it was really important about, do money managers beat the market, and how much does the market really make, and all that kind of stuff. Okay, but this is going to be 3 calculations that you must do, because it is my belief that, I'm 46 and don't have any money in the market whatsoever. I'm in the financial services. I'm securities licensed. I don't have a single dollar in any sort of S&P 500 index or Apple stock or anything like that. I don't play the market at all because of the research that I've done, and also just my personality. I don't enjoy that kind of gambling and things like that. But if I enjoyed the gambling and it still didn't make more money than the safer strategies, I still wouldn't be putting a whole lot of money into it. I'd just have enough to play with and have some fun, but I'd make sure that the bulk of my money was earning the higher returns that we're getting from the safe strategies. But I want you to be able to know this with conviction, not just me, okay? So the first thing we're going to look at on this podcast episode, 124, 3 calculations you must do. What has the market done since 2000? So those of you who are watching the video, or if you're listening to this in your car, you can go watch the video later at watchcharlie.com, but I'm just going to go to Google and type in something that maybe you wouldn't know to type in, so this could be really helpful. It's just 4 letters, but I'm going to put S&P 500, which you've probably heard of, S&P 500, and that's not the 4 letters. The 4 letters are CAGR, C as in Charlie, A as in Apple, CAGR, G as in Gary, let's say, or George, I don't know what the military uses, but R as in Robert. So CAGR. So S&P 500, CAGR. And I'm going to put calculator. A lot of times I like to put calculator to find the things that I'm looking for, because somebody's gone back and done the research or created a nice calculator for us to use for different things. So there's a couple of different pieces here that I want to show you. The first of them, we're going to go and pick this one from MoneyChimp. On my search, it turned up right at the top. It's this MoneyChimp Features Market CAGR. Now, CAGR stands for Compound Annual Growth Rate. So if you've listened to my podcast episode called Is Your Advisor Smarter Than a Fifth Grader?, you'll know that the money management world, the joker brokers and the money managers and most financial advisors, either by ignorance or immorality, they're either doing it on purpose to hurt you or they're just making a mistake. They're using a type of math that doesn't tell the truth. It makes the stock market look a lot better than it truly is. If you have $100,000 and you lose 50%, your $100,000 goes down to $50,000. Now you only have $50,000. You've got a smaller portion of money, and that's how all stockbrokers and money managers work. Your account can go down in value, can go down in size. Next year, this is not how the market works, but next year, if the market were to go up by 50%, so it went down 50 and then go up 50, you're only earning 50% on the $50,000, the smaller account, because you've already lost money. You're not earning 50% on $100,000 like when you lost it. So $100,000 goes down to $50,000, then you get 50% increase. It goes from $50,000 to $75,000. So you're only making $25,000. However, the way the market is allowed to tell you that happened, if you don't use compound annual growth rate, is what's called the mathematical mean, or quote average. So you want to throw away averages basically completely. You do not want to let your advisor use averages, or you want to switch to an advisor who doesn't really do that. Because what's the average? Well, you lost 50, then you made 50. So a negative 50 plus a positive 50 equals 0 divided by the 2 years. You're averaging 0%. Well, no, you're not averaging 0% because you're down $25,000. You literally went from $100,000 to 50 to 75. You're down $25,000, but they're allowed to say you're averaging 0. So when you hear things like you're averaging 7, 8, 9% in the market if you leave the money in there long enough, or you see on your statement over the last 5 years you've been making 8%, last 10 years you've been making whatever it is. That's not true. You're not making that money. They're lying to you. It's purposeful deception. It's allowable malpractice. 1 and 2 are the 2 episodes I did. This industry is allowed to lie to you. It's part of why I started the show, because who's going to protect you? Who's going to tell you the truth if from the very top, the governing agencies know that advisors are doing this and say, yeah, that's okay? No, it's not okay. You need to see. Nobody cares more about your money than you do. You need to be able to see for your own retirement and your own decisions what needs to be done. So here we go. I'm going to, those of you watching the video are going to see I was checking to make sure that my audio was working, and it looks pretty darn good. All right. So compound annual growth rate of the stock market, we're starting with this Money Chimp CAGR calculator. I'm going to go ahead and look at recent history. I don't really care what happened in 1871. I don't really care what happened in 1970. I'm going to put January 1st, 2000. So from January 1st, 2000 to December 31, 2017. Now today's New Year's Eve of 2018, so they'll probably have updated numbers in a week or two or whatever, but let's just use the 17-year time frame recently is pretty good. Plus 2008 is a year that things have been kind of dropping, so it may actually make it look worse. But I'm not going to click adjust for inflation. I am going to include dividends because there's something very important here. When I hit calculate, the very first thing I need you to know, if you're listening and if you're watching, the place you want to go with your eyes is this right here. Second down says annualized return, which is your true CAGR, your true compound growth rate, 5.37%. 5.37%. So for a 17-year period, where during that 17 years we had the longest run-up ever in the market from 2008 till 2018, and this is only including up till 2017, which is fine, but during that time frame for 17 years, all the money, all that we averaged to take a risk before fees, if you include the dividends, which I'm going to talk about in a minute, was 5.37%. So a very simple question I'm going to ask you first. Is that your goal? Are you looking to make 5.37% with risk? Most people are not. Most people have no idea that's what they're getting. And by the way, you're probably not even getting this. Most people have no idea that that's what the market is providing at this time. Now, why the confusion besides the fact that joker brokers lie? Let's go back to January 1980 or 1970. Let's do January 1, 1970 through December 31st, 1999. And I think these are the right numbers. Boom. Let's see. So there's a 29-year period where the actual annualized return, the compound annual growth rate, money on money, compound, eighth wonder of the world, was 13.78%, measured the right way. Yeah, baby. That's exciting. See, that's when risk was worth the reward. And that's where all the baloney and the old beliefs that people are not willing to give up on is coming from. Yes, there was a time while the baby boomers were working and the market was booming that risking money, dealing with all the ups and downs and all the emotions that causes, even paying a fee, pay a 1% fee, maybe that's not 13.78, maybe it's 12.78, but making almost 13% year after year after year, that was better than CDs and things like that, right? Better than annuities back then, better than life insurance back then. Yes, there was a time where money was making 12, 13, 14%, and it was worth the risk. That's not now. That's not this time. That's like looking at the weather or traffic reports from the 70s, 80s, and 90s. We need to look at what's going on right now in the last 17, 18 years, the time frame that you are living in. More importantly, and I'm not clairvoyant, more importantly, the last 17, 18 years doesn't even really matter. It's the next 20, 30 years that matter to you. And as you get closer to retirement, you don't have time to recover from losses. The last 17, 18 years, the market hasn't even been giving you great returns. And we've got the baby boomers retiring, and supply and demand would tell us, well, if the people that were buying drove prices up are now selling, isn't it possible that they would drive prices down? Of course it is. It's probable, not just possible. So I'm changing this back, for those of you watching the video, from 2000 to 2017. Well, if annualized return is 5.37%. By the way, that's if you don't pay anyone any fees and you're truly in the S&P 500. You're not spread around like the Joker brokers do, where you have a little bit here, a little bit there, a little bit there. You just bought the index from Vanguard or whatever, and we're ignoring the fees. Most of you, by the way, don't have. Let me just do adjust for inflation real quick. You hit adjust for inflation and hit calculate, and your 5 point whatever goes down to 3.16. So we're not talking about an awesome strategy. The market is not all it's cracked up to be or what you've been told. All right, take off the inflation, include the dividends. Why do I say you're not really getting this? Guys, money managers don't say things like this. They don't say, hey, let me charge you 1%, give me all your money, and since the S&P 500 index has done better than almost every money manager, I'm just going to put all of your money in the S&P 500 index. You're not going to be spread around. There's no pie chart with different colors on your statement. There's no complexity. There's no international. There's no, whatever, small cap, large cap, blah, blah, blah. That's already done inside the index. They don't just give you one tool and charge you 1% to manage it. Why do you think that is? They don't do that. Somebody showed this to me a long time ago, and it made a ton of sense, and showed me how to use what are called correlation reports, which I'll talk about. But if somebody charged you 1% a year, so you have $500,000, they're charging you $5,000 a year, and all they did for you was buy the S&P 500, you would very easily, any savvy investor or just normal person would very easily be able to go and say, well, can't I just buy that index without them? And what does that cost? And you find out through Vanguard and places like that you can do it much cheaper than 1% a year. So all of a sudden, the money manager looks useless, is useless. So the reality of what's going on out there, that money managers are useless, shows up, and you'd fire them. So instead of buying you the S&P 500, where you are going to get all those dividends and have them reinvested, because that would make them look like they're not doing anything, which they aren't, what do they do instead? They don't use the top 500 most widely traded stocks. They make up their own stuff. They spread it around, and they call that, quote, diversification, and they have you buy a ton of different stuff. Now, if they're at one of the Edward Morgan Lynch firms, one of the sort of retail sale mutual fund organizations, the company is going to tell them what they have to buy because they're getting kickbacks from the big mutual fund companies. It's not what's best for you, but it's what's best for the company that's selling it. And they have to put you in whatever their boss or their company wants them to sell, or else they lose their job. So you certainly don't want that. But even an independent fiduciary like me, nobody's telling this person what they have to do, but they've chosen to do money management using false data. They say you're going to make 7, 8, 9%. What they're going to do is spread you around in a bunch of different positions. You're going to own pieces of different companies, different mutual funds, different ETFs, and things like that. Okay, so now it looks like diversification. It's not like you can go price it somewhere else. It's like if they just put you in the S&P 500, you can just say, why don't I just buy it without them? You can't do that because they've created some complexity. However, someone like my team can come along easily and hold them accountable and just do something like this. There's a very simple correlation report. Morningstar has it. Some other places have it. So we have the tools to do it for you. We just put in the positions they sold you. Just put in the quote spread around or the diversification you supposedly have. Just put it into the software and then just hit a button, and the button asks a question. The question it asks is, do these things go up and down together? Meaning, how correlated are they? Because what diversification is supposed to do for you, the only reason to spread stuff around and not just buy the S&P 500, which is already spread around across the top 500 most widely traded stocks, the only reason to have like that diversification or spread it around is some sort of protection. When some things are crashing, we want something else making money. We want some sort of balance between things that are going down and things that are going up, and that's what diversification is supposed to do to protect you. Well, guess what we find when we run correlation reports on these crazy, portfolios that people build to try to make themselves look like you shouldn't fire them and like they're useful and they're doing something. We find that whatever you're put in is basically 100% correlated. It all goes up and down together anyway. So, if you have like a whole bunch of eggs and you put it in 7 different trucks and they all go down the same road with the same pothole and all the trucks hit a pothole and all the eggs break, diversification didn't really help you that much. The trucks need to take different routes. You know what I mean? Like when they're transporting a president or some sort of famous guy and you don't know which car he's in the movies. Dun, 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 dun. You know, which limo do I follow? It's hard to tell. Which one's he in? That's what you want. Most people, when we use a correlation report, and I'm going to stop talking about this because I'm beating a dead horse. I don't know how to do that. Stop beating the dead horse. He's already dead. I don't know how dead horses could make that noise if he's already dead, but moving on. So I'm going to move on from that, but if you have stuff spread all over the place, you're probably not even making these dividends that you would have if you just bought the S&P 500. That's the point I really wanted to make, is that spreading around to make themselves look like they're worth the money, because if they just sold you the S&P 500, you'd say, I can do it without them, takes away a lot of these dividends. So I'm going to uncheck this. I'm going to say we're not going to include the dividends, because we're going to assume that a lot of you are not getting the dividends of the S&P 500. Then I hit calculate from 2000 to 2017. Your compound annual growth rate, what you would really have been making in compounding, goes down to 3.38. So let me put it back in there. Let's say you just bought the S&P 500 without an advisor. Over the last 17 years, you might have been at 5.3. Not great, before fees. Take it out, you would have been at 3.38 for risking your money. The market went down 38% in 2008. There's significant risk here, and we're due for a pretty big crash. That's not worth it. I mean, you can make your own decision. No way ever would you find me telling my mom, telling my clients, or taking any of my own money and putting it at risk to make 3 to 5%. It just doesn't make any sense. 1970 to 1999, I'll take it. I'll take the 13.5 compounding. I'll even pay somebody a fee to get me that 13.5, so I'll net 12.5. That's fine. But 3.5 to 5.5, no way. And this is before management fees. So if you didn't have a money manager and you didn't have any fees, and you bought the S&P 500 in 2000 and waited 17 years, you would have made 5.37% compounding for 17 years. And as we know, in 2018, the market's been going down, and who knows where it's going to go, but that'll lower those numbers if you left the money there. But what about people that aren't getting the dividends and they're paying a management fee? No dividends takes you down to 3.38. The manager might be 1%. You might be at 2.38% or 3%. Guys, I've said it over and over and over again. When risk does not equal more reward, when more risk does not equal more reward, you must fire risk. Risk is not presenting anything wonderful in your life right now. Those of you on the video, I'm just going to go back into history a little bit and look at CD rates, because you have like 3 places to put money if you're talking about basic investing for retirement. And I'm not talking about things that require your time. If you're a day trader, or you know how to flip real estate, or even if you have rental properties that you're managing, you're studying them to buy them, you're negotiating them, and you're either managing your tenants or you're managing the property management company, that's not investing. That's like a part-time job. Trust me, I've done it. We can argue, we can debate, and do whatever you want to. If it takes your time to research and study the stocks, bonds, and mutual funds, or the real estate and things like that, that's a job. That's activities that you're doing that make you money. And of course, you deserve to make more than 7, 8, 9% per year. I would never do any type of marketing for my business if my returns were 7, 8, 9% a year. I want to make $5 for every $1 I spend. I want to make $8 for every $1 I spend. At least 3-to-1 ratio. Every dollar I spend, I need $3, so a 300% return in 4, 5, 6 months I want from my job. Investing, just letting money sit somewhere with no effort and letting it grow, that's where we're looking for 6, 7, 8, 9%. Well, there used to be a time, because there's 3 places that you can basically choose to put money: bank products, the market, or insurance products like CDs and annuities. Each one of them has had their heyday. That's why there's so much confusion, because you got to change with the times, but everybody wants to point to history to say what's working. It's not what's working 20 years ago, it's what's working now. There was a time CD, so if you look at the screen, I pulled up historical CD rates, and I got, bankrate.com, historical CD rates, whatever, from 1984 to 2016. There was truly a time, if you look back at 1985 or 1989, whatever, there was truly a time where grandma and grandpa could sell the farm, put their money in the bank, and be making 8, 10, even 12%. That's the entire retirement plan. You give the bank $300,000 and make $30,000 a year for the rest of your life with no risk and no fees. It's a CD, for God's sakes. You get what you get, and you're good to go. So why did anybody ever stop doing that? Why do we even talk about stocks, bonds, and mutual funds? And why do we even talk about annuities or life insurance? Because banks don't pay that anymore. If you look at this graph, it went in about 1990, it was at like 7.5%, 8.75, between 7 and almost 9, still in the 90s. That's pretty awesome. Then it dropped down under 7% and hung around there at like 5 to 7 until 2000. Now we've been looks like under 4% or under 5% pretty much since 2000. 5-year CD in 2002 was 4.25. Okay, so there's a tool that used to work. It used to be the retirement plan, sell whatever and put it in the bank and live off the interest, and then it stopped working. What did the retirement planning industry do? They said, well, what else can we do if no-risk CDs or low-risk CDs aren't going to take care of us anymore? And they went out and they found what I beat up on all the time now, which is asset allocation and diversified portfolio and stocks, bonds, and mutual funds. And guess what? They were right. You were being a savior. You were preaching the gospel if you came to people and told them, guys, and I'm doing it on the screen for those of you in the video, from 1970, hey, we've measured this. From 1970, let's just go to 1990. I haven't even done this yet. Let's see what it says. 1970 to 1990, we're going to include the dividends. Say, from 1970 to 1990, if you left your money in the market, it would have made a true 10.82%. And by the way, those of you who are watching this online, you can see this number above it, average return 12.15. That's the lie. That's the number that they all use. When they say, if you remember, I said 100,000 goes down to 50, then goes up to 75 grand, but they can say you're averaging 0 when you're really down 25% of your money. Here's that lie number, that false number that you get on your statements and that every advisor uses. We want this one below it. So yeah, they say, oh my gosh, if for the last 20 years you didn't use the bank, especially now that they're not paying well anymore, and you left it in the market, but we diversified it, you'd have made almost 11%. And all of a sudden, of the 3 places to put money, CDs, the market, or insurance companies, the market rose to the top as the right thing to do because risk was worth the reward, and I agree. I think it was right. If I had a show back then, I'd be talking about that. All I'm saying is just like when CDs stopped paying well, and we said, what is paying well, and switched to diversified portfolios and asset allocation, all I'm saying is that's happened again. Diversified portfolios and asset allocation have now stopped paying well. And it has a lot to do with the age of the people that buy them. This giant group of people called the baby boomers who aren't working and saving as much as they are retiring and spending. No one should be surprised if what was the biggest group of people, while they were buying something, the price went up, and now that they're selling it, the price is going down. That's pretty basic economics, supply and demand, okay? The money has to be there to buy these shares of different stocks and these different mutual funds for prices to be going up. Just one mutual fund unloading Apple stock or buying Apple stock can change the price themselves. By the time they start selling it to the time they finish selling it, the price has changed. So we're not talking about one mutual fund. We're talking about all of the baby boomers. You understand? This is a huge force, huge group of people that have affected many, many industries. The school industry, Gerber Foods, housing industry, all that. They're now selling off things to take income for retirement or to move their money to safer places like annuities and life insurance. So all that's happened is we have another change where we still have to measure the 3 places you can put money. Should we go to CDs right now? No. If you're looking at the screen, I don't know, we don't have 2017 on here, but the rates today are probably 1, 2, 3%. They're pretty crappy. Should we go to the market? No, because for those of you watching this, and I've done this over and over and over again on this podcast, January 1st, 2000 to last year, New Year's Eve, and we'll find out in a couple of weeks what we have for 2018, but right now we have through 2017. With the dividends, has only been 5.3%. Without the dividends, which is what most of you have, has been 3.38%. You've just been tricked because from 2008 to 2018, your account has been going up. But who's really measuring how well it's doing compared to the other things you could have done? It used to be CDs. Then they stopped paying well. Then it was the market. Now the market has stopped paying well. And so we go back, those of us who are honest, we go back to the 3 places and say, of the CDs, of insurance company products, of the market, who's been doing well since the year 2000? What's paying really nicely right now? And that is the only reason, besides the fact that my age group tends to not like losing money and can't afford it. It's the only reason you hear me talk about insurance products and annuities is because their average during the last 2-3 decades that matter, their average is better than the stock market. And it's really funny to me. By the way, Zizeko from that last podcast where I called him a coward for leaving a 2-star review and lying to you guys, using the platform of my reviews to lie to you, Zizeko has not been in contact to debate me on my show and show you guys what an intelligent person he or she is. No word. Everybody gets the same offer. When you hear me say something like annuities and life insurance have compounded higher, more rapidly, compounded better, you make more money, you'd have more money in your account, more income for retirement than stocks, bonds, and mutual funds, everybody gets their panties all up in a bunch, but nobody will actually come on the show and say why they're upset about that. I understand some people are addicted to the stock market and they like the numbers from the 70s, 80s, and 90s. They don't like today's numbers. More importantly, more apropos, is people don't do their research. They just work for some company that tells them what to think and they don't question it. But the market has not done that well. So the number one most important thing I want you to see, and by the way, let me do another website so you see it's not just this one. Oh, there's that one. What does this one do? That's interesting. Let's do this one. I did that search. I'm just going to hit the back bar. Okay, so I picked this one, dqydj.com / S&P 500 historical return calculator. You can watch the video on watchcharlie.com if you want to find the same one. And I'm going to go in here and pick some periods. They've got 40 years, they've got 30 years, that's fine. 20 years and 10 years, those are interesting. I'm just going to change our 20 years to 18 because I like looking at from 2000 until now. It catches 2 of the crashes that are what we need to be concerned about. So I'm going to go ahead and put that in there and come down here. Oh, my favorite guy, good Lord. Blunder number 9, buying annuities. Billionaire money manager and best-selling author, blah, blah, blah. Warns retirees. Everything that guy writes is a lie. He's terrible. The world's worst financial advisor, really should be in jail. So I want to calculate this guy. Let's go ahead and hit calculate historical returns and come down and see what it says. The reason I'm doing this is I want you to see from a bunch of different calculators where these numbers I'm saying are coming from, right? So here's a company. Now they're using average return, which is the kind of the lie number. And they're saying over 40 years, 30 years, 18 years, and 10 years, the S&P 500 would have been 6.5, 6.6, 6.6, and 6.7. So the number one thing I want you to understand, this is, by the way, before management fees. So if you're not using a money manager, I just want you to understand, the market is not paying 12%. It's not paying 9%. It's not paying 8%. Before management fees, using a lie, it might be paying 6 or 7. Now, these guys have another calculator that I like even better. They have one called a dividend reinvestment calculator that I really liked the results from. So we're going to go ahead and go into here, click this DQYDJ, return calculator with a dividend reinvestment, blah, blah, blah. I probably have to click on something to find it. I'm going to go ahead and calculate this thing and just see what happened here. And says, oh, okay, here's your total returns over that time frame. That 18 years, annualized S&P returns, blah, 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 blah. Annualized S&P 500 returns with the dividends reinvested, 4.6%. Without the dividends, 2.68%. I'm telling you, this isn't me making this up, right? If you go to these websites and look, and that's what this first podcast is about, okay? The 3 calculations that you must do, the number one calculation that you must do is to understand that the market has not done that well in the last 17, 18 years. And I'm going to wrap it up now because I beat this dead horse over and over and over again, and dead horses don't make noises, so I won't even try again. But the market doesn't pay what you've been told, and there's some financial reason for each person who's telling you that it does. But nobody cares more about your money than you do. And what you need to do is find out which of the 3 places to put money, CDs, the market, or insurance products like annuities and cash value life insurance, which one of them at any given time is paying more than the other ones? Who's beating? And by the way, we can run a report for you that just lays them all out next to each other. So you don't have to trust us. You can just see for yourself. But right now, CDs aren't doing well. The market's not doing well. Annuities and life insurance are, which is why you always hear me talk about those. That's why so many episodes are on that. Other than that, I don't have any strong opinions on the subject. And why do I do this? Because I think you people are the best.
Renovating Retirement with Charlie Jewett.
But that's all, folks.